Welcome to Sectors Up Close. I'm Elena Casas. Today we're focused on US small caps and my guest is Matt Miskin, Co-Chief Investment Strategist at John Hancock Investment Management. After a surprise fall in consumer price inflation last week, the market has moved to price in a rate cut from the Federal Reserve in September as a virtual certainty. And that means a long-awaited rotation is finally underway. Real estate, utilities and industrials all rose last week as market gains that have been concentrated in big tech all year show signs of broadening. The rising tide has lifted small caps in particular. The Russell 2000 gained 6% last week after a year when it has trailed behind the S&P 500's 17.7% growth. So is it finally time for unfashionable small caps to shine? Let's ask Matt Miskin of John Hancock Investment Management. Matt, hi. Are small caps then potentially the big winners of a rate cut?
They are likely going to benefit from lower interest rates. They need capital. So these are more leveraged companies. They have more debt on their balance sheet. And if you bring down that cost of capital, they can use that. They can tap that capital and then they can likely benefit from it. And so that's what you saw. We do see better opportunities in mid caps, more established, a bit higher in market capitalization, higher quality businesses. But what we're seeing is this tactical trade opportunity here unfolding because it's all been one trade, tech and everything else. Everything else is starting to get some love here.
In which sectors, Matt, do you particularly see opportunities?
So as you go down in market capitalization, industrials is the biggest sector in mid cap, and financials and regional banks are actually the biggest in small cap. We actually like industrials more than financials. Financials right now love the thought of lower interest rates, but eventually that's going to hurt their net interest margins and it's going to hurt kind of their deposit beta, it's called. So basically the interest that they benefit from on the short end of the curve. Industrials right now are just going to benefit from lower cost of capital. They like the strength in the US economy. So we're playing more industrials than financials. But again, as long as it's not tech, everything else can actually see some better returns.
Zooming in briefly, Matt, on those regional banks, most of them report this week and next, and you pointed out in your notes that fundamentals will be essential to try and propel this small cap recovery. What are you expecting from the smaller banks?
So what we're seeing so far is the larger cap banks are doing pretty well, actually. The Q2 results have been above estimates so far. As they go down in cap, it's been tougher. It's been really a change in perception of some of the smaller cap banks where they're not getting as much business relative to the larger cap, more stable counterparts, which is kind of what we're seeing. We're actually higher in market cap on financials. But what's interesting is the industrials dynamic is almost the opposite. Larger cap industrials have been struggling, some of them aerospace and defense in particular. Mid-cap industrials have been doing better because they're more focused on the U.S. economy. So in regional banks, we're still waiting there for a better reset and earnings potential. We're playing more industrials.
On the banks front, should potential investors be worried about the exposure of these smaller banks to bad loans, particularly in commercial real estate?
Yes, and that is really, again, why lower interest rates helps these regional banks more, because if you bring down interest rates, that makes real estate more attractive on an income basis. It also can help them get another lifeline in terms of leverage, potentially rolling over their debt. So again, it's that lower rates helps us small caps in those banks because they have that real estate exposure. But we would fade some of that strength because eventually that is going to come back to the fundamentals. We still think that is going to be a lingering risk for that part of the market.
Going back to the winners of this rotation, those companies that are most exposed to the ups and downs of the US economy, are we seeing the kind of consumer strength that those companies need?
Well, we have retail sales coming up this week, so that's going to be a key indicator. But overall, we're not seeing that much strength in terms of the consumer. It's more kind of holding up. I'm not saying it's cracking much, but it's not growing much either. What's happened is really the price of everything has gone up with inflation. Even though inflation looks to be decelerating, some other prices have come down. They're still elevated. And our earnings growth, the kind of average hourly earnings or people's wages aren't growing as fast. So it is becoming more challenged. We've got to find those companies that are growing earnings better. And again, why we're focused more on the fundamentals in this part of the economic cycle.
Given the events of the last weekend, Matt, should investors be worried that the risk of political instability in the US could perhaps throw the Fed off its course of rate cuts?
There's certainly a lack of pricing in of geopolitical risk. I'll say that. Valuations on equities are pretty elevated. You've got interest rate spreads on high yield junk bonds pretty low, meaning they're not pricing in much risk. So there certainly could be greater volatility around this. Politics isn't often actually as big of a driver as earnings and the economy. And what we're seeing is those parts, whether it's the economy or earnings, those are holding up well. And then the prospect of even the Fed cutting rates in the back half is almost putting a Band-Aid on the market, providing less volatility. So as long as that's what's going on, we think that it's going to be okay. But look, we're okay looking at some defensive options in portfolios as well, because they're on sale, frankly, and they're pretty cheap to put on in case there is greater volatility ahead.
Matt Miskin of John Hancock Investment Management, thank you so much for joining us. Well, that's your roundup of US small caps. I'm Elena Casas, and this is Reuters.